All right, guys. Here we've got another lesson for you. Okay, so this is saved as chapter 14. Honestly, the way I end up doing these slides don't match up exactly with the chapters. This one is really kind of more of just a like revenue recognition type um, topic is what we're focused on. So different types of contributions and stuff like that for nonprofits. Okay, so first thing we have to make sure you understand is what is an exchange transaction. An exchange transaction is where you give up something of value and expect to receive something of equal value in return. So just think of, I don't know, maybe you bought gas this morning, you you know paid money, used a credit card, whatever, and in return you received gas. Okay, so exchange transactions can also work for services too. So let's say you got a haircut or something like that. You paid money, and in return the person cut your hair. Okay, so those are exchange transactions. Now, obviously, this is a little fancier definition. What I prefer to do is not necessarily, and I don't think you need to memorize the definitions that come from the FASB, but instead what you need to do is make sure and you have it clear in your head what it means. So when you see the concept exchange transaction in your own words, you could describe that in basic terms and really understand what it is. But anyways, this is their fancy definition. From a revenue recognition standpoint, it's the same as for-profit entities. Okay, so we recognize revenue when it's earned, and yeah, like when we've done the work and we expect to receive the money in return. Okay, that's like the definition from the FASB. So for exchange transactions, that's where the nonprofit would actually be giving something up of value. So let's say they're doing a fundraiser and they're selling donuts or something like that. Then we'd receive, we give a person a donut, they give us money, we recognize revenue, and it increases our net assets without donor restrictions. Okay, so if we do what sometimes it'll be called cost of premiums, that's like calendars, coffee mugs, stuff like that. If we hand those out, then they're classified as fundraising expenses. Okay. And then difference between fair value of dues or other purchases amount transferred is classified as contribution revenue. Okay, so that's exchange transactions. Exchange transactions can exist for not-for-profits. It can also, obviously, it exists in for-profit businesses. Okay, now contributions are also recognized as revenue, but in this case, there is not there's nothing that we're necessarily like giving in return. Okay, so it's unconditional, voluntary, and non-reciprocal. Okay, so basically a non-exchange transaction. So think about this as like whatever, you love animals, you believe in the Humane Society's mission, so you give them money. You're not expecting anything directly in return. Now, you do expect them to use that money to further their mission, the Humane Society's mission. Okay, so these contributions can be given with or without donor restrictions. It just simply means, without donor restrictions, that's probably normally how most ordinary people give money, right? Because it's not huge amounts of money. So we just give money and that's that. With donor restrictions, that is, more, I'd say, sophisticated donors or people who are giving larger amounts of money. Normally, they're always going to give with donor restrictions. So they're going to say, it can only a certain amount can be used every year, or or it has to be used for a specific purpose within the organization. And we recognize these donations, again, they are revenue. We call it contribution revenue. We recognize it when it's given as support, and we recognize it at the fair value. Donated materials are also recorded at fair value. Now, if they are consumed at that time, so think of like a veterinary supply company, if they give bandages or something, let's say there was a tornado that came through and injured a whole bunch of animals, so they gave bandages. Well, the organization would recognize that as contribution revenue, but then they would also record it as an expense. So the contribution revenue is the credit and the debit would be an expense, right? As they use up those, as they use up the bandages, okay? Or, you know, if it's a fixed asset or something like that, then you debit that asset. Donated services. I don't think I went through this as much with your group, but if I did, sorry. Just always, you can speed these videos up or skip through things too. So donated services. The really big key for this is either requires specialized skills, okay? So think of a lawyer acting as a lawyer, like helping draw up legal documents, an accountant doing accounting work, or a doctor working as a doctor for a nonprofit. So it has to be specialized skills. So always look for that. Or the other thing that it can be is it can enhance a non-financial asset. So what that means is like if it's repairing a building or repairing the roof on a building or putting in new walls or something like that, that would be enhancing or creating a non-financial asset. So that is also recognized as contribution revenue. So it's like this one or this one. Okay, it has to be one or the other. Okay, there has to require specialized skills. So think of just anything that has like a professional certification. In class, we were talking about like a CDL driver. If someone donated their time and their truck to deliver a semi-load of stuff, that's a specialized skill, and so that would be included. Okay, what they'll try to trip you up with is they'll talk about this normally have to be paid for part of it. So they'll say, oh, this person donated, let's say, they'll try to trip you up. They'll say like a CPA donated time to help unload trucks, and the organization would have normally had to have paid to have those trucks unloaded. Well, the issue is it was the CPA doing it, but he or she wasn't using their professional certification to do it, right? They were just unloading a truck. And so the fact that it would normally have to be paid for doesn't matter because this criteria here wasn't met. So hopefully that makes sense. We'll do some practice ones on this. And then this journal entry here was just that one that I was showing. So sorry, it's whatever drawn through, but basically there's contribution revenue, and then in this case it was either an expense because it was consumed or an asset if it has a longer lived life. Okay, pledges. Pledges are just really important that you understand fundamentally what's going on with the pledge. So an unconditional pledge, the difference between just a contribution and a pledge is a pledge depends on something else happening. But if it's unconditional, then we actually get to record it, because the pledge, it really just depends on the passage of time. And so there isn't something that is outside of our control or outside of our ability to do in order for us to receive the pledge. Therefore, we get to recognize the pledge as contribution revenue. Okay. So if it's unconditional, then it just depends on the passage of time. So if someone says, hey, I'm going to pledge $10 million over the course of 10 years or something, then we do get to recognize that as contribution revenue, and we get to recognize it at the present value. Well, also net realizable value, you'll see why, because we do an allowance account for uncollectible pledges. Okay, so that is an unconditional promise. Okay, so like in this case, sorry, I don't know why, just PowerPoint doesn't like my iPad, but we record our pledge receivable, and then we record contributions with donor restrictions. That's because of time. So that's our credit. So it should be over here a little more. And then we also credit an allowance account for uncollectible accounts or uncollectible pledges. And we just base that off of like either industry standards or some percentage that we've calculated within our organization or something like that. Okay, so that's unconditional pledges. Then when we collect the money, and in this case, we collected the full amount, so we debit cash with donor restrictions and then credit, reduce down the pledge receivable account. Sorry, that's cut off. Okay, now conditional pledges. So these ones here, they depend on something that is outside of our control. So think of an organization like they receive a pledge to build a daycare facility. Okay, big pledge, $10 million or something like that. But the pledge is contingent on the city building a bus stop there in front of the location, the daycare location. Okay, because it's a conditional pledge in that case, we don't get to recognize the revenue. We have to wait until we meet the conditions of the pledge. Because see, like we don't have control. We can't force the city to build a bus stop in front of the daycare location. Or another one that they do a lot of is they'll say we receive a conditional pledge of $10 million, but we have to raise another $10 million. Okay, because like we can influence that we raise that other money, but we don't have complete control over it. So we don't get to recognize that contribution revenue until we raise the match. They call it the matching funds. Okay. So if they give us money in advance, so they say like, here, you know, we're going to pledge $10 million to build your daycare facility. We'll give you $100,000 in advance to help get everything done. The $100 in advance is actually a liability, okay, or in this case, $4,000. So that's that cash, we receive it. We have to do a journal entry for it, okay, but we need to record it as a liability, because if we don't meet the criteria for the rest of for the pledge, then we have to give that money back. So just be aware of that. Okay, agency transactions. With agency transactions, the logic behind this is a lot of times not-for-profit will receive money that has actually been earmarked, or like the donor has said like, hey, this money needs to go to this other organization. So it's like big organizations will do this when they do fundraisers. So like, what's the example that I was using? A bigger organization. Let's just say the Red Cross. Okay, so the Red Cross is doing some type of fundraiser in our community, but it's for a specific project or a different organization that is going to carry out a project for the Red Cross. Okay, so what you're looking for is words about whether or not we have discretion or variance power. So if the problem says that we don't have discretion on how the money is used, or we don't have variance power, then you need to record it as a liability. So you'd receive the cash, cash, and then credit a liability account. Okay. So the variance power means that we have control over how the money is spent. If we don't have variance power, then we have to record it as a liability. Okay. So that's the logic behind agency transactions. I'm trying to think, there's an organization that does this more. It's a big organization. I just can't think of who they are. But anyway, that's the idea behind it. Okay. Okay, now other concept is financially interrelated organizations. So this concept here is where we have a parent company, okay, and then the parent company may have a whole bunch of subsidiaries, okay. Now in this case, the parent company does have control over all of these subsidiaries, okay, and so both things have to exist. They have to have the ability to influence the operating financial decisions of the other entities. So it's like this entity can influence these other ones. And also the entity has to have ongoing economic interests in the other entities. So if that's the case, then a contribution to any of these smaller entities, the subsidiaries, or the parent, like that's financially interrelated. And so ultimately, it's just the main company, the parent company, that ends up recording and reporting those contributions. So the important thing with this is both things have to be true. Okay. So and it just creates these residual rights, okay, in the value of the net assets of the parent. Okay, so let's look at a few examples. I'm going to give you more examples to work through. And so I'll do that shortly. Okay. So they're considered financially interrelated organizations in the event that one of the organizations, so this is just wording, right, is both able to influence operating financial decisions of the other and has ongoing economic interests in the other. So B is the correct answer there. Marble Foundation, a not-for-profit organization, is financially interrelated with its beneficiary organization, Boulder University. Receipts of the Marble Foundation will be displayed and disclosed in Boulder University's financial statements as. So what this is, because the Marble Foundation works for the university. So if the Marble Foundation receives money, then it's going to be a change in the university's interest in the foundation on the statement of activities. Okay, so B is the correct answer. Because the university has interest in the foundation. The foundation works for the university. If you look at the others, an increase and decrease in donor restricted conditional support. Like I could see the increase in donor restricted support, but I don't really see the decrease because it's only talking about receiving money. No disclosure, no. I mean, these are one entity, right? And then equity transaction wouldn't be an equity. Equity transaction. They're not equity transactions because remember in not-for-profit accounting, we don't have equity, right? We just have net position there. So the ownership is just a little different. Okay. All right, next one. So investment in securities. Okay. So debt. So this is just like debt investments. So if a not-for-profit has extra money, they can buy treasury bills or some type of debt investment or equity investments. Okay. We're going to measure them at fair value, bottom line, which is the exact same rules for for-profit accounting. Okay. We record unrealized and realized gains and losses in the statement of activities, just like you would for-profit entities. So nothing crazy there. Pooled investments, that's just where like multiple entities would get together, pool their resources. Like, one nonprofit may not have enough resources, investments to justify like a financial advisor or whatever. So they kind of pull their resources so that they can have they will justify using an investment firm or something like that. So those gains and losses would just be allocated equitably, right? So if you put in 10% of the investments, then you would take 10% of the gains or losses. That's all that's saying. Yeah, and then the investment income is reported in the period that it's earned. So nothing crazy there, just your normal rules. And then we do recognize the change in fair value of derivatives. There isn't special hedge accounting rules for not-for-profits. That's not going to be tested heavily. Underwater endowments, all that means is they gave us money as some type of investment, and the fair value of that investment goes down after we receive it. So we need to disclose fair value, the original gift amount, and then the amount of the deficiency or how much it's went down. So if you look at this example, we received $10 million. It's some type of investment, right? So let's say they gave us $10 million in equities and other types of investments. And then at the end of the year, the fair value is $9,750,000. And so we would just report, how much we received initially, what the current fair value is, and then how much the deficiency is. Okay. Not a huge thing with that. We do have to kind of report on endowments and our ability to spend them, stuff like that. How they will be appropriated, investment policies, composition, net not-for-profit endowment by net asset class, things like that, reconciliation, beginning and ending balance. So that's all kind of the same. So this is just talking about like basis of assets. This is all the same as for-profit accounting. Okay. So when we buy an asset, we use the cost principle, record it at cost. Donated fixed assets are recorded at fair value. They will try to trip you up on that. They'll try to get you to get into kind of the tax rules and stuff like that. And so, yeah. And then this about works of art, historical treasures not being depreciated. I can't remember if I went into that with you, but there's some criteria there. Let me know if we haven't went into it. Okay, so if we look at this, received a gift of T-bills. The cost was $20,000, $50, $500 brokerage fees. Treasury bills had a fair value of $15,000. That's all we care about, is what the fair value was. So what should they be reported at? $15,000. Received equity securities valued at $100,000 as a gift without donor restrictions at the beginning of the year. Received $5,000 in dividends from the securities, and then at the end of the year, the fair value is $110,000. So by what amount did these transactions increase RST's net assets? So it increased it by 100,000, increased it by 5,000, and then increased by another 10,000, right? So we just add that up. So 10,000 plus 5,000 plus 100,000, so 115,000. Okay, that's everything on there. I've got to get you guys some practice problems that you can work through. Even if I put them in, I may put them in as a quiz, just so you can, I don't know if I will. Anyway, even if I do, don't think of it as a quiz. Just think of it as practice problems. So anyways, thank you for watching, and I'll keep in touch with you. Bye.